Welcome to the People, Property, Place podcast with me, your host, Matthew Watts, founder and managing director of Rockborn. This is a podcast where I share the stories, views, opinions and career journeys of the movers, shakers, innovators and leaders in the real estate industry. Welcome to the People, Property, Place podcast. Today we're joined by Anne Copeland, co-head of social infrastructure at AlphaReal. Alpha is a specialist real estate investment manager focused on secure income strategies with over 4 billion of assets under management. They invest in UK and European assets with predictable, secure, long-term cash flows. These investments cover commercial ground rates, UK renewable infrastructure, social real estate and secured lending, combining operational real estate expertise and fixed income skills. Anne is an experienced fund manager and has worked at Aegon Asset Management, Aviva and Schroders in one guise or another. She studied land management and development at Reading University and is a Chartered Surveyor, and even finds the time to sit on the AREF Corporate Governance Committee. Anne, welcome to the podcast.
Thank you.
Not at all. Well, look, I know you've had a fantastic career. I'm personally really interested to learn a little bit more about your route into real estate and what you've been doing. And I know from a kind of a social and an impact perspective, it's very much in vogue, but you've been doing it for years. But before we get onto that, can you tell me a little bit about your route into real estate and how you decided to pursue a career in this space?
Well, it wasn't intentional. I took a university place at Exeter, reading maths and economics. Hated it, left after the first term, and quickly looked at where my A-levels would fit, and Reading and real estate was a perfect fit for my A-levels, so I fell into it.
What did you do in your A-levels then?
Maths, economics and geography.
So you were quite strong technically and mathematically and business-wise?
Yes.
And so real estate, where did you have any family influences? Or?
No family whatsoever, no accountants, so avoid that.
So family of accountants.
Yes.
And so how did real estate kind of like come into your subconscious, or how did you even realise that there was a kind of an opportunity to pursue a career there?
So back then it was literally a university book. So there was nothing online. And it was literally, where's the match for my A-levels? Where would I probably get a place? And I was offered a place really quickly at Reading.
Really? It was literally that simple?
Yeah, and looking at the course and thinking it's quite outdoorsy as well as indoorsy and very varied and potluck.
Really? So not even the geography, maths or economics? Because that is quite a good, if you're going to be strategic about it, those A-levels probably lend themselves really well to kind of a career in real estate.
Yeah, they were the A-levels that the course said would be the preferred A-levels. So I thought I've got a chance to get in really quickly.
So you got in the car, left Exeter, drove up 303, landed at Reading.
No, took the rest of the year out and was working for Chelmsford City Council, registering day nurseries and creches under the 1989 Children Act. So very random to earn some money until I went back to uni.
Did you get any sort of inclination in terms of how the real estate piece worked? Nothing. And then you kind of, made some money, went back to uni and then got kind of stuck into your course at Reading. And how soon did you realise it was the right kind of fit for you?
Pretty early on. It was a good mix of people, probably 90% male, which is usual, 10% women who were all good fun, and varied course, lots of law, lots of maths. So it seemed a really good fit, and I enjoyed it, and just, it worked for me, Reading. It was a brilliant place. I thought, just carry this on, and then managed to get in every year work experience in some holidays, and also managed to get a scholarship for women in property, which was the first scholarship they awarded. Awarded it to two of us in 1992. We were the first two girls.
And so you got the scholarship, and what did that enable you to do?
It gave me money, £3,000. So I gave my brother my student loan and I used that money instead.
So that helped fund your university?
Helped fund the university, and it gave really good access into working for Chartered Land, part of the Kingfisher Group, for some part of summer holiday. That was who it was through, and then other surveying firms as well. So I was really fortunate to have effectively summer holiday work.
And so you had your theory at uni, but then you also had some practical experience in terms of like applying it to the real world and really understanding what real estate was.
Yeah, so both in my first and second year had placements, and then got a job offer before leaving university, and in my second year, actually, unconditional offer to join Chesterton, as they were then known.
So you joined Chesterton. Did you do the milk rounds of interviews, or it was literally you got your conditional offer?
No, did the milk round, got an unconditional offer from them. So, and they had an umbrella of services. It sounded wonderful. You could work not only in London, but across the country.
And so you joined, and did you do a rotational program, or were you kind of straight into a particular?
So I joined Chesterton in 1995. They had like an umbrella of services, so they were sort of had a lot to offer, varied sort of start to your career, and also had departments across the country. So I could work in Bristol, for example. However, on arriving, it was fairly obvious fairly quickly that the umbrella of services meant they weren't very good at anything, and the staff weren't very motivated. This was 95, and it was very much not a growing business at that point. So the training really wasn't there. Yeah, so it was quite a quick, rude awakening. And the guy that recruited me said the advice is to get out as soon as possible, which I did.
So how long were you at Chesterton's for then?
6 months.
Really?
Yeah.
Is that in your nature to kind of like pull the cord on stuff quite quickly?
When the head of recruitment is telling you not to be there.
You'll just take that advice.
Take that advice.
No, I'm just thinking in terms of extra. No, because it seems there's a certain self-awareness, or trying to understand maybe if that's like a streak that comes up in your kind of career. Because you can read things. I'm just trying to understand. Is that?
Well, it comes from my brother and I, with my parents, emigrating to Canada. Got lots of family out there, and coming back. So it didn't work out very well. Lots of issues, employment issues and health issues from family back here. So we came back and went back to the same school, which was quite embarrassing. So if you can weather that as a teenager, your friends taking the mickey, you sort of are happy to pull the ripcord, because you know that there aren't many things worse than probably emigrating in, this was in the late 80s. So house price growth, house price collapse, came home, currency change. So parents had to get new jobs. Yeah, so a real reset.
So if that was like the bottom, actually saying to your mates at Exeter, this isn't for me, I'm off. It's no actual big deal.
Was not a big deal.
Landing a job at Chesterton's, then being told this probably isn't the best environment. You're like, okay, fine, I'll go and do something else and make something of yourself in a new environment.
But that something else wasn't going to be surveying, because I was so disenchanted. So I looked to join, don't laugh, the Metropolitan Police Service. Very fortunately for me, I wasn't very good at press-ups at that time.
Are you good at press-ups now?
Better now, but I wasn't then. And the sort of advanced path, I did quite well at my degree, so they were like, oh, we'll fast-track you. But it was really clear, really obvious, in the recruitment phase, this was not for me. So I went to a recruitment consultant in the phone directory called Abchurch, ABC. It's the first one in the book. And they happened to know William Hill from Schroders really well. And they happened to share the train with him. And he happened to say he was looking for a new graduate. So
you got into real estate. We're going to leave based on quite a bad experience with Chesterton's, but actually fortuitously ended up at Schroders.
Through turning up to a recruitment office and then literally having had a conversation with William that morning. And I knew people at Schroders because I've been at university with them, some older, 2 years older. They knew me, and they said, yeah, come and interview.
So you landed at Schroders, and you were there for about 5 years, weren't you? Can you just talk to me about Schroders, the business back then, what you were doing? And clearly you must have absolutely loved it, because...
Yeah, so some advice I had subsequent to that, but actually really worked at Schroders, was join a growing business. And they absolutely were. They had their main unit trust CPUT fund, which hit $1 billion while I was there, which was, monumental back then. And then I worked with Tony Brown to launch SERPUT, the Emerging Retail Fund, which was their second fund. And this was way before retail warehouse parks and all of that. That developed in my latter point at Schroders. So it's just really well-run business, growing, fun place to be, lots of experience. Yeah, and a complete polar opposite to my start at Chesterton.
Which is obviously an advisory business. This was on the principal side, calling the shots. So were you kind of put into a particular team, or did you have an area or a focus?
Yes, I worked on retail investments. And you're a client, but you've got your own, but you've also got a client yourself. You've got the trustees and the board. So I never really saw myself as a client. You're just part of a chain. I think if you always have that approach in life, then you probably remain the relevant levels of humbleness.
Yeah, quite. Yeah, everyone's got a client.
Ultimately,
yeah. Someone they need to report into and do well. So you were in the investment team, responsible for, was it out of town retail or high street retail or shopping centres? UK retail wide.
And it was an era of telephone calls constantly, fax machines, Computers really weren't, turned on very often in the office. You turn them off and on, bizarrely then. And an intranet, but not an extranet. So it was really sort of the start of technology changing, but most information was by fax.
And what was it about that role that you loved and kept you there? Yeah, can you just expand on that?
I think it was a growing business and the people, really nice people. And you could see that some people have been there many years and are still there, actually, all this time later. And that speaks volumes, really. And the new joiners were quite like-minded, and it was fun. And I think if you feel valued, you stay. So I qualified there as a surveyor and was IMC as well there. So did quite a lot in that period of time, and then sort of took the view that probably ready to move on, because they had unit trust structures and others in the industry were focusing on new fund structures and other asset classes. So that's where I went on to.
What's a unit trust for someone listening to this who doesn't know what that means?
So it's where investors collectively pool their money together into a vehicle, which happens to be called a unit trust, and they are issued very simply units in that vehicle. So it like being issued a share in a company, you have so many units, they have a unit price, and they're traded on a regular basis. So lots of good governance, non-exec directors, just really well managed. And unit trusts were the go-to structure back in the mid-90s.
And were they listed or
non-listed?
Non-listed, but they could exit them by selling their share or their unit to someone else, or were they locked in for a defined period?
No,
of
back
time?
to manager. But this was pre-REITs, really. So,
fine. So you had some good experience from a transactional perspective, got qualified, did your IMC, I guess realised or reaffirmed that actually real estate is a career path you want to go down and you are good at. How did the move to, it was Morley, was it? Or
well, they were known as Aviva then changed the name to Morley, then back to Aviva.
So how did Aviva come about, and why did you choose to change? What was the...
Just ready to move on, ready to do new things, work across other asset classes within real estate. So I'd just done retail and was quite keen to do other things, and was intrigued at job interview when I was told basically, we'd like to take you on, but we're not going to tell you what you're going to be working on. It'll be a surprise. We hope a nice surprise. And I thought, well, why not? Sounds intriguing. So I joined a business not quite knowing what I'd be doing.
That's quite a big risk, isn't it?
Well, they seem really nice people, and they say, so, judge on interview, lovely interviews. They're a really growing business as well, a very friendly business, and sort of had the vibe that Schroder had in the early days when I joined Schroder, had that equivalent vibe then. So I just thought, yeah, great, good, hopefully a good place to move my career onto.
So you turned up day one at Aviva. Can you tell me what that scrappy folder that was placed on your desk said? Or was that not quite day one in terms of you working out what you're going to be focused on?
It was pretty much day one, and it came after an interview where the person who interviewed me, who remained nameless but probably will remember, had half of their lunch stuck to their arm at interview. So I was slightly put off that the sandwich was sort of moving across the desk. But that person gave me a lever arch folder with the phrase on the front, noir, not office, industrial or retail. So I open it up and it's medical pharmacies, hotels and care homes, which was, they were not sectors that were heavily invested in back in, well, this was 2001, and some of their investments had been going since the late 90s. So they'd actually had these assets for a few years, and thought that a girl might be good to manage them.
That was literally it.
That was pretty much it.
Because the darling child of real estate at that time was office, retail or
retail warehouse parks were coming on, yeah. So industrial, at the start of my career, was actually the sort of the third sector, because it was office and retail, and industrial was seen as a bit alternative back in the mid-90s. And obviously it's completely mainstream now, but bizarrely it was the third of the two. And then, this folder was the sort of, have I got a hospital pass here, or is this the best thing that has happened to me?
Yeah, so
didn't quite know.
So you didn't know from a mindset, so you just thought you open this up, hotels, medical centres.
What did I know about end-of-life care homes or acquired brain injury units, or all I knew is that you go around the buildings and it was quite upsetting what you were seeing, but that the fundamentals of the investment seemed to make sense. This wasn't discretionary spend, Bond Street retailing that I might have had at Schroder. This was needs-based. You thought, well, actually, you can see there's longevity in this asset class. But this was before data. So, you couldn't log onto a website and find out data about trading of companies, their occupancy data, their, the performance, their EBITDA. None of that really existed. So you were looking at paper records. Regulator was in its infancy. So these are highly regulated sectors now. And you go online and you can check out a tenant's regulatory status. You'd have to request a report and have it in hard copy. So it was quite difficult day to day to run assets in those sectors, and perhaps that's why people didn't do it. But Aviva, took the view that they thought it was really interesting, and they had these assets on their own books, on their own balance sheet at that point. So there wasn't third-party investment; they held them on their balance sheet with a view to creating a third-party business down the line.
That's really interesting. Because care homes would have been around, there would have been hotels. Was it just private individuals who own them, or just kind of smaller property companies? And who else was dabbling in this space? And then what also drove Aviva to acquire these assets?
Yeah, well, Aviva had a sort of a JV with a company called Quintain back then, you may know very well, and they had a pool of care homes. Much of the industry, or quite a lot of the industry, there were local authority owned homes, and the government often changed rules and regs around these things, changed things like requirements for the width of a corridor in a care home, and then realised that their own portfolio didn't meet those widths. So we were dealing with all of that all the time. So third-party institutional capital wasn't in that sector in anything like the way it is now. I mean, it was, the concerns for investors were about PR. What if something goes wrong? Will our name be in the media? So that was the concern about a lot of these operational businesses. So I think they were very much, Aviva were quite ahead of their time to go, yeah, we'll be involved in this. We'll be landlords, and we'll get to understand the sector. And you learn more by what goes wrong, and not much went wrong, but things go wrong. You learn more by that than when it all goes well.
So they owned, they were the kind of the propco, or they owned the
real
estate.
Estate keys.
Who owned the operational part of
so
the
tenants,
business?
So lease to tenants on the whole sort of, which slightly has become a dirty word, but sale and leaseback model. So lease back for 20, 30 years. The view that the operators in these sort of needs-based services generate a lot of goodwill, and they need a long lease, because if you're only given a lease for 5 years without a right to renew, you've generated all your goodwill and then have to move. So there's a really good alignment between what the landlords wanted was long, stable income streams, and the tenants wanted to know they could be there and trade for a good length of time and build up. These businesses, you don't open a care home or a hotel day one and it's full. You have to build that business up. So long-term patient capital is really key, and that's insurance businesses were that capital source from the get-go.
Interesting. So tell me about your team, because you mentioned they wanted a girl to come in and look after it, which is unbelievably sexist and wrong on so many different levels. Who else was in that team, and who were you reporting to?
So no women at the time. I reported to Phil Clark, and directly effectively into Ian Womack as well, and a guy called Chris Laxton. So, guys in the industry, really good fun, and they'd worked on some of these funds as well themselves, so they understood operational businesses. And then it was probably a year or two down the line that more women joined the team and got involved. But it was no surprise to me that it was quite male orientated, and that wasn't a problem. And they were interesting assets. I'd always thought, God, an office is really boring. What can you do as a landlord? But these businesses, you can go around, you can look to see how their operations vary between different tenants, who are the winners, who are the losers, who's got what strategy, how's it working, what are the drivers. You can understand the drivers behind why that tenant is going to have a good occupancy in that building. What's the ageing population? What needs are they catering for? So actually, it's you could sort of piece the jigsaw together and go, well, yeah, this investment should work in this location for these reasons. And I never felt that with something like offices or retail so much. I always felt it was more of a bit of a lottery, really.
So did you enjoy being in part of the market that wasn't necessarily sexy or mainstream? And did that kind of give you energy after the kind of initial shock of realizing, actually, this is going to be my focus in a new job?
I don't know about a joy. I wasn't bothered about it. I didn't think that actually, oh gosh, I'm gonna be cornered here in a dusty cupboard for 5 years, and everyone else has got more sort of sexy, interesting jobs. Didn't feel that way at all. So I suppose I didn't consciously think about it, because I was enjoying what I did and learning a lot, and the sector was really evolving, so it wasn't boring. In fact, I remember one time saying between quarters, is any quarter ever the same, because it really wasn't. So that was actually, in hindsight, quite exciting. But sometimes you felt, just have 6 months where things don't change too much, because it was quite exhausting. But you were layering your knowledge without realising it.
And your role, because I appreciate you kind of moved into an assistant fund management and fund management role. It was everything from transactions to asset management to reporting to portfolio work. Is there anything else that was included within that, or you just like the variety of it as well?
Well, I worked across not just healthcare, I worked across PFI, regeneration, high-yielding industrial. So at Aviva, you were given lots of different things you could work on. So over the years there, you always worked on 2 funds at the same time. I worked on a number of different funds, but with a predominance that they were not core sectors. And also got quite involved in the marketing as well with the team. So presenting to potential clients and talking about the strategy, which I realised that's the bit I really liked.
So I guess in terms of your role evolving, you had quite practical hands-on asset management, investment, fund management skills, but actually the piece that you enjoyed was like raising new capital or raising funds, structuring, and what kind of institutionalizing or maybe not institutionalizing, but bringing kind of like the product or the investment class a little bit more mainstream.
Yeah, and actually the asset management was outsourced to a third-party specialist, and that was really key in those days. And then it was having someone in my role that knew enough about their role to ask the right questions, but know when to let them do their thing. So you'd present to investors jointly, effectively, and I worked with some really good people there over the years who just were really specialists at that, and that's what you need. And in terms of moving forward at Aviva, I did that role for quite a few years, working on different funds, and then went on maternity leave, had twins, so it was off quite efficient, not very many maternity leaves. And before leaving, it was just the era of a change in stamp duty regulation. And Aviva, compared to Schroder, Aviva had all their structures were limited partnerships, English limited partnership structures. So you owned a percentage of this company. And the government decided to change the rules that partners couldn't swap their unit or sell their partnership holdings to somebody else without incurring stamp duty. And when I went on maternity leave, I said, look, we're going to have to, we were on a project working with lawyers to think, how can we tackle this, which was bolting on offshore unit trust structures, mainly through the Channel Islands. And that was the growth of the whole of the Jersey, Guernsey, Luxembourg vehicle. So I worked with lawyers at Nabarro, so some really powerful women there at that point, Deborah Lloyd and Catherine van der Spar, who were really at the forefront of, people like Aviva, who had 13 billion of assets in these structures. And overnight, the value could change, because if someone's only, the route to sell their part of their holding would be incurring stamp duty, then it probably wouldn't be trading at 100% value. So I said foolishly, when I come back, I'll work on that with you, and which is what I did. So help move all those funds offshore and also set up for the team that were remaining, the fund managers that were remaining, sort of the rules around doing that. Because being in such a big firm, if one of the team slipped up on all the governance around this, and there was a lot of governance, you could bring the tax structure on shore if you did the wrong thing. The view was it could be a house of cards. If Aviva had done it on one fund, they could have made the same mistake across all their funds. So I worked to try and help people with sort of what to do and what not to do guides. Really simple.
So what, structuring to effectively avoid capital or capital gains tax, or being liable for...
Avoid the structure being seen to actually be managed onshore, not offshore. It had to be seen to be managed offshore, and it absolutely was, and it was properly managed offshore. But for example, making a statement on an email, the wrong statement saying, yeah, we send it to the board to rubber stamp to just sign off, but don't worry, the decision's already agreed. That could, if the revenue saw that could cause the tax structure of the whole vehicle to be questioned.
Is that because the board meeting had to happen in Jersey or Guernsey?
Yep. Offshore, not in the UK, all outside the UK. It could be an airport. Yeah, we had them in when it was fog bound, various airports, anywhere, as long as it was on people's holidays, as long as it wasn't in the UK, you could hold the board meeting outside the UK, and therefore it wasn't, and hold them in person and have the correct notice period for the documents, quality questions, do everything properly. But I suppose Aviva was one of the first to do this and do it at scale.
Yeah, I was going to say, did you copy anyone else, or were you kind of really like leading the charge in terms of setting the example?
So Nabarro were absolutely vanguard in it, in working with Aviva and getting it all through and making it operational.
And so how did your role develop post that introduction of rejigging all the structures?
Yeah, so I then worked effectively between the offshore teams, who were third-party administrators, and the onshore fund management team. I was sort of the go-between in the whole thing. So to make sure effectively the operations of all these funds were done appropriately and weren't going to then question the tax structure. So I was that sort of go-between of making sure that no one slipped up, and being on boards as well. So being on advisory boards, we had various JVs, people like Tesco, we had Retail Warehouse Park JVs with, and I was a director on those boards as well. So I stood back from being day-to-day fund manager on funds and took a slightly different role within Aviva.
Interesting. So you took a step back from the kind of the day-to-day property piece.
Yeah.
And did you always want to do that, or did you kind of miss the property piece when you did take a step back?
You were quite close to it anyway, in all fairness, and still close to the people doing the job. So it didn't feel too much like, it was a step sideways, really. It didn't feel I was losing anything, because I think after a period of time on certain funds, you get a bit bored doing the same thing. Even if they're growing and there's new tenants coming on board and new capital coming in, you sort of yearn for something different. So working on that project was completely different because, it was the start of that move offshore in 2004-05.
At that time, was social or ESG, was that creeping into the agenda, or have we not quite got there in terms of the picture?
No, not at all. Whilst a lot of the assets actually, if we look back now, were delivering social value, it wasn't a word. ESG wasn't really a word. It didn't, it wasn't language used.
But you were doing it by proxy, just by the very nature of the assets that you were dealing with.
It's inherent in a lot of the assets if the right assets are required and managed in the right way with the right tenant counterparties. So you probably didn't realise that was all happening. Not happening for every asset. Some would not score very well on that at all. But a lot of that, So it was always there. And I think, talk about social value and it's quite nebulous. It's always been there. It's just trying to find a way of articulating it and making it feel real to people.
At that time, were there other people kind of getting on the alternatives bandwagon, or was it still very much Aviva kind of clearing up and institutionalising the kind of the sector and leading the way there?
Well, I remember going to what would be IPD back then, but MSCI forecast days, and they looked at all the different sectors and the returns, and you'd all be in a room together and look at your sector you worked on, and there was always this other category at the end, and it might have been about 6, 7, 8% of the whole. But suddenly the returns for other were they were consistently first, and no one knew what was in this category. Well, it was all the sort of stuff I did, and it was only when it was regularly performing well that people were like, what is in that? And would like a piece of that. So I think it was from that people sort of, their interest was sort of piqued, and we started to get competition when trying to find assets to buy or when trying to work with tenants, from a point where there were, at this early days, there were more suppliers of buildings and tenants who wanted to do sale and leasebacks than there was capital for. And then suddenly you've got this weight of capital coming and going, well, this is a great thing to be involved in, and capital piled in. But it took a few years for that to happen, but that was a real table turn from, what is it now, 25% plus of the index is alternatives.
And what was the impact of all that capital piling in?
Impact was positive and negative. It managed correctly without mission creep. Managers would have stuck to their strategies and acquired or partnered with particular tenants who we felt gave quality buildings and quality outcomes. But of course, as we've seen, not just in non-listed space, but in REITs, it's sort of when there's a lot of money piling in really quickly, there can be mission creep. So there absolutely was mission creep in that probably there was a lot of pressure on managers to deploy capital because it was fees, it was AUM. So it was really, you had to sort of check yourself and go, no, are these the right transactions? You might have a lot of pressure to deploy the capital. And the investors are saying, well, we've committed to this sector, but our capital isn't drawn because it's unlisted. You don't draw it day one, you draw it as you need it. And it's almost, trying to say, look, just be patient. We want to find the right buildings with the right tenants, and it might take a couple more months than perhaps you would like it to, but you don't want to be buying the wrong things.
What do you mean by mission creep?
So if we look now, fast forward now, and we look at a number of the REITs in the housing sector who have their NAVs trading at the floor, who have been found wanting in terms of the quality of the buildings, say in social housing, and the quality of the care given, that's mission creep. And that is weight of capital and wanting deployed quickly. some of their strategies were always looking at buying, new assets and having them built. But if you've suddenly got $500 million of capital, you deploy it where you can. And unfortunately, that's a really easy example for me to give of what's happened, not 20 years ago, but it's happening today, that mission creep.
You mentioned something about the fee piece. That's because you're under pressure as a fund manager, to deploy the capital, but also once you've deployed the capital, get the fee stream off the back of it to pay for your fixed costs and enable you to keep doing your business, right?
Yeah, I mean, you're paid on NAV or GAV. I always run geared funds, many geared funds with debt, but you've got that. You've got trying to do the right thing by the investors, but also you're working for a company who wants to make money. So that interplay, and you need to be to have balls, so to speak, metaphorically, to stand up. And there were times in those businesses where you had to stand up and be prepared to ruffle a few feathers, but say, no, this isn't the right time to be doing this. But what I will say is I've worked with third-party asset managers who had the same thoughts. They were saying, we shouldn't be taking in the capital now. What we should be doing is paying down debt, or what we should be doing is another strategy, and supporting me in that. So you've got to prepare to be quite bold and prepare to stand your ground. But ultimately, you work for a company.
Yeah, it's that balance between doing right by your investor, but also a business and making commercial decisions. Where does alignment come into the frame in terms of making sure that you're balancing both parts?
Well, these funds, people could sell their holdings to somebody else, to sell their units, if it's a unit trust structure or limited partnership structures. So if a client wanted to get in quickly, they could try and acquire somebody else's holding and pay a premium for that. In sectors which were, there was more appetite to come in than there were available capital to be deployed. So where I've worked in those sectors before, where there's a real hunger from investors, they've often bought on the secondary market and paid the premiums, and that's given them, at that point, okay, I can access that asset class quicker than if I have to wait for primary market. So me saying, hey, we're open again for more money coming in. But the quid pro quo of that is the pricing. But if they're long-term holders of that strategy, paying another 2-3% going in probably doesn't make that much difference.
And the majority of the investors did have a long-term view when they were partnering or looking to kind of get into the alternative space as it was.
Yeah, they did, because actually a lot of this was very much demographic-led, needs-based led, and people could see the trends. I mean, at one point they thought there were too many of these buildings compared to demand, but we could see what was happening to population growth and the really elderly part of population growth. And also people are getting older, but unfortunately they're also less well. So we used to talk about, back in 2000, having comorbidity, so living with 2 life-limiting conditions. Now we talk about multiple morbidity, so living with, more than one life-limiting condition, and there are quite a few folk in that position, much younger as well. So it sounds awful, but someone else's problem in this sector is actually a landlord's gain, because you've actually got your tenants have got a steady flow of users who want to use the facilities, who want to get better outcomes in terms of their wellness, their health, their lack of not being socially isolated, being careful in the right place. And over the years, we've seen that the demand for these sectors from users has just grown exponentially. And you go around a care home and it was pretty much all elderly women. We're now seeing more men as the differentials in life expectancy are narrowing. But seeing lots of people survive accident, injury, and with quite complicated medical conditions that need support much younger. So Parkinson's, motor neurons disease, lots of acquired brain injury units. So lots of things that are really quite sad. But when you go to the facilities and you see actually the quality of the care and support that people receive and the wellness they get out of it, I'd always said you should always move away from that sector if you visit places and then walk away without passion. They can be quite hard visits.
Yeah, I can imagine. Also, in terms of like the scope, actually, once you've, kind of get your head into this alternative space or medical space, the kind of the niches within the niche, vast, right?
They're huge.
And then, as you just alluded to, like the opportunity from a capitalistic perspective, again, is vast and probably growing exponentially as well.
So it moves across into the housing sector, so housing with care and other types of housing use, and through to education. So we've talked about medical conditions and people surviving conditions, but also better diagnosis. So, for example, SEN, special educational needs, is something that 20 years ago wasn't well understood and really is now, and diagnosis. So the growth in special educational needs schools, and that's something I now work on as well, because really there's the same, you look back in terms of the drivers to, would that be a sector that's going to perform well as an investment? Well, hell yes, it will, because it's almost like care homes in the day. This is the new growth area, and even day nurseries, because ultimately, without day nurseries, in the main, women can't go to work. So a number of us in the businesses have used them, or used nanny services, and thinking, well, there's such a shortage of really quality early years education, and we know the benefits for the children are great, but also the benefits for the families, because it means that if it's a traditional 2-person household, both can go to work.
It's a net positive, but also there's a real opportunity from a real estate play to influence.
Real estate play and social value. Because actually, you've got, an example, you'd have had a whole load of degree educated women at home with their children because there weren't day nursery places. And now they're able to go to work more often and contribute to society. And we're asked recently for retired men to get back off the golf course. Well, actually, the focus should be trying to get a lot of women that are at home back into the workplace, who are at home because of these barriers.
Can we talk about, because I'd love to expand on that further, and I'm sure we will, but can we just talk about Kames Capital, Aegon? You left Aviva in 2008
Yes.
and moved to Kames.
Yeah.
Interesting time in the market from a global financial crash perspective. Did you see it coming? Was Noir, recession-proof back then? Or was it just interesting timing and the opportunity presented itself and you wanted a new challenge?
I think, Aviva was growing obviously at a slower pace because it was a difficult market. But there was a trigger. Some of the team, key members of the team, left Aviva to set up the real estate business for Aegon. And I was asked to join as part of that. Sort of in the second wave, said, would you come and join us? We want to create new funds in the areas that you've got experience in. And I thought, actually, I'd like to get back into doing fund work and back into raising capital and going out there and creating some concepts of funds and seeing if investors like the concepts, getting their capital, deploying it, and doing it all again. And that's what excited me about joining Aegon, as it was known at the time, and then changed its name to Kames Capital.
Got it. And that was insurance capital backing the sector as well.
It was a bit like the Aviva. It started with insurance capital, but the aim was to bring in third-party capital and create new funds. So that's what I worked on, bringing in third-party monies through new funds being created.
Interesting. So you would have diversified income stream, but also you could access different sub-markets depending on the capital that you'd raised?
No, not at all, no.
Okay.
No. So raising separate funds that did different things. So had a healthcare fund, had a active value strategy fund, which was higher yielding, short lease duration commercial properties. So different fund offers that investors said, well, actually, I like. So an active value strategy would be more capital focused in terms of its return. Healthcare, more long-dated income, with more income, so 2/3 of the return being from income. So it's a style preference for investors.
Got it. So you could productize it, but also I guess at that stage the market or the alternative space had grown up, matured. There's obviously a lot of money chasing it. Yes. You segmented it down to kind of match investor preference and what they wanted to access.
Yeah, I mean the team were quite narrow in its strategy. It was solely what I call one pillar healthcare. It didn't include housing and education. It was just health. But the team were very good that worked on that, and the fund performed very well. And over sort of 12 years, the investors had more than 10% returns. So, launched in 2010. So launched still in a difficult market and operated during the growth period of REITs. So from the growth period in 2014 of REITs coming in, that weight of capital coming in a sector, chasing the same strategies, was a hard place to be in a non-listed structure.
Can you expand on that and say why it was a hard place to be and why was it challenging coming up against REITs?
Because they had a load of capital and they could outbid.
Because?
They wanted to deploy their capital.
So it's as simple as that. And it wasn't anything to do with the tax structure or the way that they had to deploy or return capital to investors.
No, I mean, some investors will be happy to be in a listed structure, some, and the argument is a listed structure, is it a real estate return, or is it an equity return, or is it a bit of both? You can make an argument for everything. And other clients liked non-listed structures, they liked closed-end vehicles, so you've got what's your style preference as a client? Open end, close end. What's your investment horizon? Do you want to be with people that want to be there for the long term, or perhaps shorter term capital? What you want to do as a manager is not think you've got one thing that everyone wants. Well, what do they want? And can you, in some way, offer some products that meet some of those needs?
At that time, was the kind of the client pool or the equity pool, was it widening, both from like a geographic perspective, but also kind of mentality, private equity coming into the frame as well? Did that feature?
So the client pool was mainly pension schemes, so DB, direct benefit pension schemes, private schemes and local authority schemes, because they just saw, they understood the sectors and they liked the long-term nature of the income stream. And when you're talking about leases of 20, 25, 30 years, annual increase to RPI with caps and collars, you could liability match, you could see that return would be, you would never see the same yield hardening that perhaps city office may do, but never see the same, jolt when the market sees offices out of favour and suddenly the yields go up to 7%. It would always work in a narrower band of return. So you'd market it saying it's got a low standard deviation of return. So it's, you know more what you're getting. And then the risk is, well, you're partnering with the right manager that can deliver that income return for the long term, because bluntly, a long lease is only as good as the ability or desire for the tenant to pay. So if you structure it wrong with the wrong tenants and then there's tenant failure, you've got to be a manager that can handle that, put a new tenant into an asset, and that takes time and takes capital, and you have a lowering of income while that will happen. So it seems really straightforward, but actually investors wanted to partner with somebody that had all those experiences so they could pick the winners from the losers and look at businesses and see, where do we think that tenant's got an alignment in terms of their growth aspirations, what segments they want to be in the market, what geographies they want to be in, what types of buildings. If you had a tenant that only wanted really old Victorian terraced houses to operate care services from, that wasn't a good alignment with where we felt quality outcomes would be, which was back in the day, having a bathroom facility in your room was, not common in a care facility, but that's where the market demand is now. So for ensuite wet rooms, so that a person being cared for has dignity and also infection control. And obviously with COVID, most people understand that now, but we were trying to explain why that's really important
to investors,
and also to tenants. You wanted to work with tenants who saw the value of paying more rent to have those facilities than perhaps facilities that are not purpose-built and not bespoke for that use.
Interesting. Was there ever a point where you dabbled in the operational aspect of running these schemes, or it was just with the real estate specialists and we'll partner with the operating businesses because they're the specialists there, and we'll partner with the best ones who are going to scale, that we know will pay the rent, they've got good product, we know what they're looking for, and we can kind of scale and build it out that way?
So not taking operational risk, it wasn't risk that clients wanted to take at that point. So no, it's always been as a landlord effectively. But what I would say is ultimately when these assets are valued, the valuer will look at the trading data for the building. And, in any operational business, if there's a hotel, whatever it is, they'll look at trading data. So although you're not operating, your success of the business, of your investment is completely linked to the success of the underlying business. If the data's going the wrong direction, you need a really good explanation as to what's happened. It may be, why is the occupancy changed in a building? Well, in this building, the tenant is doing some refurbishment work somewhere, or so therefore they've taken a corridor out of use. So therefore occupancy is lowered for a while before it then reestablishes. But you need to understand the story behind the maths so that the value will understand that and work with you. If suddenly, EBITDA, your earnings is down, your occupancy is down, the tenant's getting in trouble with the regulator, not got very good regulatory scores, you're going to see the yield of that asset move.
Back in the day, landlords would lord over their occupier. It sounds like it's much more partnership and collaborative and customer focused. And I know real estate generally now is, in the last 5-10 years, it's kind of very much been on that journey. But it sounds like from an operational perspective, that's been like at the core of the relationship from day one, or part of the success of it.
Yeah, it is. And I think where you look to examples where things haven't worked out the way you want them to, is where there wasn't a good alignment in that, and that perhaps some businesses had different focuses. And certainly in the early days for operational businesses, some businesses would fail, and then a few months later, those directors and running another business again. And they didn't seem to concern themselves about that PR around that. They rose like phoenixes somewhere else under a different name. But, investors, everyone, we are, you're really wise to that. So you want to look at businesses that you actually, you've got to eyeball these folk, and do you trust them? What's their history? Talk to other people in the industry about them. So it's a lot of data gathering, both quantitative and qualitative data gathering. And in the early days, it was a lot more qualitative data because numbers didn't exist for these businesses. And now there's a much more focus on the quantitative side of analysis as well when you underwrite a transaction in operational businesses, more so than there ever has been. So
and I think that's cross-sector, isn't it? But probably specifically also. Across
what I work on, health, housing, education, you wouldn't underwrite a transaction, you wouldn't buy a building based on a qualitative approach, going, I think we trust them, we like the business model, everything else. It's got to, does the math stack up as well? How do we score the risk of this business? And therefore, what yield do we think is appropriate to pay versus what the counterparty wants?
Yeah, quite what the agent just puts the yield as,
and with a lot of work, it's off market, it's originating. Where we haven't come onto that, but where I'm now, a lot of it is originating directly. So if the counterparty you're working with has an aspiration and you just can't get to it, then there isn't a transaction.
Talk to me about your new role at AlphaReal and how did that come about, and what is it that you've been kind of brought on to do?
So it came about because I left Aegon in selling down one of their specialist alternative businesses. I sold that down in 2022 for them and said that I would leave the day that transaction was complete, which I did. So we never knew what the date would be because it was a big portfolio sale, but we knew that literally when the documents are signed, that would be my last working day for the company. And knowing that, I then took the advantage of undertaking a diploma with the FT, a non-exec director diploma, because I saw actually the direction of travel was a lot more into ESG, was a lot more into the listed space, being really hot on this, and what's our strategic report, what are our values, and actually having to articulate it to investors. And they were really much the vanguard compared to non-listed space in real estate. So I thought, well, I'd like to understand a lot more about this from that perspective because non-listed won't be far behind. So I took the opportunity to do that and then really wanted to find a role that I'd be excited about again. So looked around and do I go down the sales and marketing side because I've done a lot of fundraising? Do I go down the fund management side? I sort of like both. So at Alpha, actually, I can do both, which is the beauty. So raise capital on the funds that I work on, but then also have that experience of still working in the sector and working on those products. So you don't lose that interest in those sectors.
Can you give me an overview of the sectors that you're invested in and the portfolios or the assets in the portfolios that you have?
So it's quite simple. It's essential needs-based services, which sounds very boring, but it's really stable as an investment class. So it's in health, it might be GP surgeries, through to care homes, through to specialist uses such as something like a fertility clinic. In housing, it'll be housing for people who have special needs, which may be physical and mental health needs, and often together, those needs. But really the aim is to have independence and to start being able to live in apartments with the care coming in and support being there so that you're hopefully, people are getting the individuals getting the most out of their life and their well-being and are being appropriately supported and aren't being in the wrong settings. So aren't being in an institutional setting or aren't being at home with an ageing mum or dad, which is not going to work for the long term, which probably doesn't give the individual their sort of sense of freedom. And so that's in sort of housing, all the way through to education. So I've mentioned a focus on special educational needs schools and day nurseries, but it's also wider than that as well. But they're two sectors that we're doing a lot of working at the moment and finding you get a lot of social value out of those segments.
And are they public and private sectors, or do you segment them like that? Because obviously one government backed and the other is private backed.
No, well, you think that, but actually there's a lot of public backing across all these segments, be it directly, so GP surgery, yes, we currently don't pay to see a doctor, but the doctors themselves receive money from the government, so that's public. But if we look at, say, a care home, depending on your family's wealth, there is government funding. So actually at the lower levels of wealth, your care is fully underwritten. The special educational needs schools, your care is fully underwritten. You won't, as a family member, it's not means tested. It's fully underwritten. If we look at day nurseries, yes, some folk will pay themselves, and it will be underwritten and a different number of hours underwritten. And if you've got children, you've probably watched the recent government announcements about what's happening in that segment. So the goalposts are moving all the time. How many hours you get covered, you've got to work, okay, how much salary can I earn and how many hours I can get free? Is it worth me taking a different job potentially and earning less for a while and being covered by government's funding of childcare, of early years care? So there is public funding running through the veins of all of this, and also in most segments an area of private funding as well. Why is that important? Someone listening to this, why is that important that there's public money flowing through these different sectors? So you could say, and not necessarily in my view, but some would say in an ideal world, all these essential services should be state funded. But we're not in an ideal world. When the state used to run a lot of these facilities themselves, they run them at higher cost with not very good outcomes. So the state isn't always a good operator of these businesses. Plus, they don't have enough capital. So we think alone in health, housing, education, it's probably a £50 billion investment opportunity for private markets. So, the sort of folk I'm talking to, private capital coming in to help offset the imbalance between the demand for these services from users and where the supply is. So if you don't have, a SEND school in your area and your child's having to go an hour and a half travel, that's not a good outcome. So you actually need capital to come into the sector to work with the tenant to have a facility built or converted for that use. And at the moment, we see an imbalance, a strong imbalance. Probably health, it's probably a 20 billion shortfall, in housing, it's about, probably about 18, and in education, about 12 billion of shortfall between what demand is actually there and where the quality supply is. Interesting. From a recruitment perspective, have you ever found it difficult to hire into your teams? Because the reason why I ask is sometimes it's just misunderstood. Because it's not office, retail or industrial, people don't understand it. They don't understand actually how good an opportunity and how big the market is. And actually the fact that it is still fundamentally real estate at the end of the day. Well, I suppose the benefit of weight of capital coming into the sector is a lot of the chartered surveying firms have big teams in these areas, and they have teams that, if you look at, I'm not going to name any of them, but they've got huge teams that deal with, they could have eight different business lines in operational assets. So from data storage through to care, through to educational teams, and fund management houses, they will be the source of staff coming through, because these people, men and women, have worked in these segments and like what they're doing. And actually, I'd like to work on the client side, or I'd like to work, perhaps in a smaller business where I feel I can get more exposure across many sectors. Because often, if you're sort of on the advisory side, you might be a little bit siloed, whereas here you can. There's an opportunity to progress. But that's probably in the last 5 years, though, is like the sector and prominence has risen, or it's just some of the big houses, without naming names, their teams have swollen in the last 5-10 years, right? Whereas before that, it's probably been quite difficult, and hence why they probably had to say to you, come and do this job, it's going to be awesome, but we're not going to tell you what it is, and kind of almost pull the wool over your eyes and present the opportunity at the last minute. Yeah, but that was 20 years ago. Wow. So I don't think you'd have to have the same. I think you wouldn't have to hide what you were doing now. These are, someone savvy in their career will look at where's the capital going. You follow the capital. So the capital has really flown into these segments and is staying in these segments. And if we look at what's happened to, with the trust, brief government and all those issues, these segments they've not seen the valuation reductions that others have, because it's needs-based. You can't, it doesn't matter what your wealth is. If you need care and support, or, you need shelter, you need housing, you need education, you all need your health. So really, we're not seeing the same yield, changes that you may see in discretionary spend. So if we're looking at retail warehouse parks or, other segments, well, you can decide to shop or not. You don't need to go to TK Maxx every week and buy something on a Friday. You just don't shop. But you do need to have your children educated. You do need to have good health outcomes for your whole family. You do need shelter, and the appropriate shelter for you and your loved ones. So, you can't turn that tap off it's there constantly.
Is there a country globally that is like leading the way within this space that the UK or you learn from or you look to, or is it very much the UK is kind of pioneering this?
The Nordics have got some quite nice ideas, but it's not everybody's cup of tea. But they have some ideas. So regulation and governance is really essential, but sometimes you think, is it too much? And when you're looking at things like dementia care, there's a real worry that people with dementia may get lost and find their way out of the building and then be lost in the community. And so a lot of what the regulators do is about, systems, procedures, controls operators have to stop that happening, to deprive you of liberty, but doing it with the best of intentions. You look to the Nordics, look to the Netherlands, and, I have experience where, folk are in the community, much more free-flowing, wandering around, and it's a different mindset. You may not agree with that approach, but I don't know whether the real rigid approach in the UK about protecting people from themselves, in a way, health and safety overload. Yeah. And you can see it's probably come around because of the US focus on litigation. And what that does is it doubles down on regulations and protectionism and everything else. But I would say some countries in the world have probably a slightly freer attitude, which I quite like. But I don't work within those regulations, so
it's just more like looking to others that can inspire you in terms of driving it forward. But that makes complete sense. You touched earlier in our conversation around social value and ESG. How do you measure that now, or is it still quite vague? I know you've got the social value portal, but how do you measure it and how do you look at it, especially with your kind of fund management hat on?
So I think taking a step back, I see what I work on as impact. And others may interchangeably use the word ESG, focused and impact. They're not the same thing necessarily, because an ESG strategy can be philanthropic and we want to really focus on governance, we want to focus on the environmental outcome without a reference to return. Whereas impact is a dual focus. By definition, it has to have a financial return, and I call that a market return, I'll come on to that in a minute, and demonstrate positive outcomes. And the focus is always the E and the S. But I always add in brackets the G as well, the governance, because the sectors I work in are highly regulated. So you've got that governance flowing through. And the return piece, well, are you looking at 5-year cash flows, 10-year cash flows? What quality of tenant, what underwrite will impact what the relevant market return should be? So I take a step back and my focus is on impact. And often that's through the lens of ESG, but actually these are impact funds. And then how you measure it is tricky still. Certainly the E, we're all sort of familiar with houses such as GRESB and everyone understanding better what you need to do in terms of reporting for that. And that's important for things like TCFD, so financial disclosures coming through and on climate related issues. How robust is your portfolio to future risks from climate? So the E side, I think, is quite well understood. We're all getting familiar with EPCs. What the EPCs of your portfolio? Where do they need to be? What's the arrangement with your tenant regarding getting there and supporting that? But for social, you sort of know some of these things must be doing good, but you can't really articulate it. So I always articulate it in two ways: story-based telling, so the qualitative story. So you can give a story in all of these segments saying, this is a practical example of how social value can be shown, both for the person receiving the service, but also the staff delivering the service. Because what probably isn't as well known, unless you really think about it, is a lot of these sectors have workforces where staff are from lower socioeconomic groups, often older, often marginalised, and often women. So actually if you work with a tenant, you focus on tenants who work with living wages, quality training, proper terms and conditions such as maternity leave and holiday pay, and then actually that's lifting folk out of, like levelling up, that's lifting folk out of what would have been irregular work and more reliance on the state. So that's an example on the social side in terms of the staff. And then it's fairly obvious the outcomes that you receive in these sectors for the users. And for each of the sectors, if you've worked in it for a number of years, well, actually these sectors are really good to reduce social isolation, which if someone's at home and not seeing anybody from day to week, what that does to your mental health, as well as having physical needs or other mental health needs, is atrocious. So some of the sectors we work in, not only do they do the obvious, so an educational setting educates children, but actually they often have other benefits, and that's where we link into sustainable development goals and saying, well, actually, what of the 17 goals do what we do as a house, or what do the competitors, what goals are met, and really drilling down into, okay, behind all this is a massive framework, a massive data sets, and you really can go, okay, this asset delivers on this goal, and these are the reasons why, and you can link it all the way through to saying, and these are the positive outcomes it delivers. Where we still need to do more work is on the quality of the real estate and how that impacts social value. And this is where the third-party measurement houses need to do more focus, and we need to, as an industry, work with them. Because at the moment you can have, for example, a care home. You can have a care home which is not purpose-built, where the washing facilities are in a cupboard in a room, literally, and open the cupboard and there's a sink. And you can compare it to a building purpose-built with a full ensuite wet room. The social value calculators may actually say they both give the same social outcomes. But we know that one will give a much better outcome in terms of infection control and in terms of personal dignity, in terms of how the person can be cared for. But at the moment, the maths around this, the data isn't picking up that differential. So we need to work as an industry to find ways of differentiating. We need to work as an industry if one building has, say, compared to day nurseries, and one is, they're both 100 place day nurseries. One has got 50 children on the roll, one has got 90. You sort of know the one with, if they're similar buildings, the one with 90 will be giving higher social value. But actually, the way that the portals work at the moment, they're not differentiating. They'll just say both are registered for the same number of children. So there's more work to do in this space. But what you don't want to do as a manager is be sort of overly perfect, and then actually, if you compare yourself to peers, you've almost been if you flex things, you need to be very explicit in doing that by saying, look, we've looked at actual data compared to hypothetical data, and peers may look at it on a hypothetical basis, and this is what our values would be on that basis. But we think of it. So, I think it's always about being really explicit
and honest. I like opening up and saying this is where it's at.
But if the way the data, if the data houses say this is how we want to analyse it, you need to put your data in that format. But if you're having a narrative conversation with a potential investor or a current investor, we'll be very open, saying we do it this way or this. So it's done that way, but actually a more proper, a more mathematically correct approach would be this. But if the market isn't doing that at the moment, you can't compare managers' products.
It's really interesting, your point around the kind of the double social value from the care end users, but then the people administering it. I hadn't even thought of that before.
Yeah, it's about this technical phrase about the underserved, which sounds really naff, but it's folk who, trying to give services to people who can't access them, quality services, but also a quality job to those providing the services. So a lot of these languages talk about stakeholders. So you've got two key stakeholders, not just the receiver of services.
Yeah, and I guess the point that I was going to make in terms of stakeholders is, because it's all encompassing, whether it's the capital, the occupier, the administrator, the fund manager, there must be a significant weight or more weight of capital trying to enter this space. And I guess all those stakeholders are demanding it and kind of trying to build the plane and fly it at the same time, right?
Yeah, and they all are. And there's a lot of language around impact investing at the moment. I mean, it's an absolute sort of alphabet soup of language, and you can get quite sort of bogged down. So what I was doing this week was writing a thought piece around that to try and demystify the language around social impact investing and trying to bring out some of these themes of what's currently missing in terms of the analysis and how we can work together as an industry. And to investors, I'll always say, look, what I know about social value reporting is that in 5 years' time, it won't look anything like it does today. But we've all got to start. We've got to be engaging today, or we won't get there. So we've all got to be quite open as managers and throw around ideas and positively challenge. And if we feel that the party we're working with to do the assessments hasn't actually really understood the essence of real estate investment and social value, then find someone that has, or work with them to develop the tool that better reflects outcomes. So it will evolve over time. It's one of those things that there isn't a standard methodology at the moment, which can, I suppose, be quite confusing for investors. So that's where I believe the narrative, the storytelling around what you do is as important as the maths.
Have you ever had mentors during your career?
Not really. I've mentored people. I've worked with someone who is now at Knight Frank, who I took on at Keynes. And we can talk about that if you like. It's quite an interesting story.
Yeah, I'd love to, just because, there's such a wealth of information that you have. And I just wanted to know if you've been advised throughout your career, because I definitely could sense that you're the kind of person that puts the elevator back down to help other people up. And I guess the other part of my question, which I might come on to, is like, what advice would you give someone who maybe like wants to access the kind of the alternative medical, housing, social impact space, but doesn't know how to do it at the moment?
Okay, so one thing I'm really quite proud about, because actually the person now is a very good friend of mine, is that a guy who was a residential estate agent who'd done his Chartered Surveying degree but hadn't found a place in the main, big firms, advisory firms, messaged a whole load of folk in the industry and said, "Can I come and work with you for a day a week free?" And I responded, and I believe also GVA responded. And we met the individual, and he was amazing. So we took him on that basis, and then over time it became a longer term role, a paid role. He was involved in social value work when I was at Keynes Aegon. Through someone that probably he didn't come from the same background as many surveyors, but he came from the background I had, which wasn't a very, wealthy background. He also was non-white, so not a background you see a lot of folk in our industry who are black. He was a minority, not in the office I was in, interestingly, but in the industry was a minority still. I think probably a bit like I did, imposter syndrome, didn't know whether he had the skills, but we worked together for many years and just focused on, he had such great skills, so bring that out, but focusing on how to develop confidence and how to build someone's self-assurance up to the point that then they leave you and go and get a really good job somewhere else, which is exactly what you want.
So you had the behaviours and you had the attitude.
Yeah,
and
just
then
the confidence.
You imparted the confidence, and then by nature, he acquired or she acquired the technical skills to be able to do the job, and now they're kind of flourishing.
Yeah, now I'm reading their research reports.
Well, maybe they're one for the podcast at a future date.
He might well be. He'll probably be listening. So yeah. But in terms of mentors from the other direction, I was thinking about this the other day. Unfortunately, not that many women, other than I'd say Deborah Lloyd and Catherine van der Spa on the legal side, when the whole industry was looking at moving funds offshore, and they were at the absolutely cutting edge of that, making that happen, and were quite awe-inspiring. These women, really, go-getting, very plain speaking, knew they're bright people, knew their stuff, and for me, where they were really good is there was never a problem. They always very much can do. We'll find a way through this. We'll find a solution. And I've always looked to people in the businesses I've worked in that are sort of solutions-based, focused. Don't dwell in the issues. Just let's cut through it and let's find a solution. And that can be people at all different levels that have those skills. So I often take, I hope I'm that sort of person, but I also have a lot of affinity with people who might be a financial modeller, who might be a lawyer. They're not always chartered surveyors, but in the businesses you work in, just sort of don't get bogged down about problems. Just find a way through and find a solution and see if it works. And if not, tilt it a bit and pivot it a bit and have another go. Have another go.
As we draw to a close, Anne, a question I ask everyone on the podcast is, if I was to give you £500 million worth of equity, who are the people, what property, and which place would you deploy that cash? So
we're talking about real estate. So firstly, controversially, I probably would look at not just real estate, but I would look at some of, and it is controversial, some of the good bits of AI and data, because I think in what I like these needs-based services. So I will park my capital in essential services, but what I try to do is park it aligned to the positive innovations in AI, so that we can focus on, when we're talking about delivering of services to vulnerable people, there's quite a lot of what we still do is manual based, and technology and data can help us in taking out some of those tasks. It will be more accurate than humans can be, absolutely. Like, say, monitoring of someone's well-being, monitoring, remote monitoring of health and well-being. There's lots more apps around this. There's you see lots of adverts for type 1 diabetics having remote monitoring. But what that frees up then is the human beings in the tenant business to actually give that person-centred care or educational approach. So I'd really like to put some of my capital potentially into the technology side. I might also, a bit of funny money, put it into things such as services for the bariatric, because we're getting a lot bigger. And so look at where the growth industry, literally, no pun intended, where the growth industries are, but they are in trying to find technology and support for folk who are living less well, who may need kit and equipment in different ways. The UK, I mean, we're doing such a good job at not sorting out those problems. I mean, our population is getting worse and worse in those areas. So a bit of capital in products around that, a bit in AI and data, then also looking at underlying operational businesses where the need is always going to be there. But through the AI and the technology, hopefully we can take some of the less efficient human parts out of that and just let the humans focus on delivering care and support, that human touch, which actually is invaluable. And if you're filling out forms and boxes and on your handheld gadgets about how many times has somebody gone to the toilet that day or how much water have they taken in, if you can actually have apps that can do all that, it frees you up for actually doing what I think your role is, actually getting to give someone a better outcome in life.
So it's merging the real estate operational business and then AI optimization across all aspects to drive that return. And geography-wise, the need is everywhere in the UK and globally. And people on the journey, anyone you'd bring along on that journey outside of your team?
Well, I think young people, essentially. I think it's all the youngsters. So don't look at your own peer group, but look at those in there, from other industries who have those backgrounds too, that can apply to real estate. So I think it's just being open-minded to some of the really, techie folk who actually got all the skills to develop these systems that us Chartered Surveyors can then utilise, because we're not always the best people to work on that. You've got to realise where your skills are and where. Yeah, so I definitely go to people at least half my age.
And you've had a phenomenal career, one that sounds like you kind of stumbled into it almost by chance or by an amazing opportunity and kind of stuck with it. You've broken down a lot of different barriers and shared a lot of different parts of the industry, and hopefully inspired some of the listeners to maybe move out of a traditional asset class and actually learn and educate themselves about a new opportunity in a growth sector that's clearly very well capitalized. There's a lot of needs and it's a growing part. So thank you for joining me on the podcast, sharing some of the pearls of wisdom, and I'm excited to see what you and the team go on to do for 2023 and beyond.
Thank you for having me.
Not at all. Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague, subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of which guests you think we should get on the podcast or areas of the market that we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit experienced talent for real estate private equity firms, investment managers, REITs, property companies and advisory firms across the investment, asset management, development, fund management, ESG, cap markets, investor relations and general practice space. So if you're considering your career options at the moment or looking to attract top talent to come and work for you, head over to the website www.rockborn.com where you can find a wealth of resource to aid your search. Have a great day wherever you are, and I look forward to catching you next time.